Hey taxpayers, have you donated anything this past year? Well, if you have, chances are it's going to affect your taxes, but how? Now, just like with any of these other videos, I do have to throw out a few caveats. The tax laws that I'm going to mention are just specifically as of today, as this is recording, which is December 2021. Again, as we are now wrapping up a tax year, these things could change. I'll try to stay on top of it, but for now, what I'm about to talk about is current tax law, which may not really change until down the road. So this probably should work for tax year 21. Now, another thing is that I will be using the terms donations and charitable contributions interchangeably. For purposes of this video, they are the exact same thing, so don't get confused if I start changing those terms up and using both. Now, another thing to keep in mind is that donations and gifts are completely different, and I will not be covering gifts. That will be another video. Now, what's the difference between a donation and a gift? Well, technically they're kind of the same thing, right? You are giving something an expectation with nothing in return. But for taxes, they're different because based on the recipient. Now, a donation or charitable contribution is only a donation or charitable contribution if the intended recipient is a qualified nonprofit. Now, we'll get into that a little bit later, but a gift is a gift to someone who is not a qualified nonprofit. So if you've given money to, say, a friend who lost everything in a house fire, that is not a donation. That is a gift, and that's got separate tax implications. But if you've given money to a charitable cause that was going to give the money to, say, someone who's lost their house in the fire, that money went to a potentially qualified nonprofit. So at that point, it's not a gift, it's a donation. So again, it depends on where the money went to. If it, again, is a friend or a family, then gift. If it's a qualified nonprofit, then it's a donation / charitable contribution. Now, this is where it gets a little tricky because it's almost on a case-by-case basis. Since donations and charitable contributions have to go to a qualified nonprofit, not all nonprofits are qualified. So you almost have to take it by case-by-case basis just to make sure if it's something that you can even deduct. Now, what exactly is a qualified nonprofit? Well, I'll probably link a little bit more of the tax qualifications down in the description. But one way to I guess generally cover your basis is it has to be a 501c3 nonprofit, and these are usually your education, your religious, or your charitable structures. So things like like your church or local religious institution, or your public school, or a university, or your Goodwills and your Salvation Armies, those are considered qualified nonprofits. So things that you donate to them are, again, donations and not gifts. Now, when it comes to donations, there really falls into two main categories. There's cash and then there's non-cash. And technically, non-cash actually breaks down into two further categories, and that would be tangible non-cash gifts. So tangible meaning things that you can physically touch, smell, taste, touch, whatever sense you want to use. And then the second would be intangible. So things that you can't touch. This would be things like your time or your knowledge. Now, I'll go ahead and touch on that one. Can you deduct the value of your time or your expertise? Then the answer is no. Now, granted, there are a few I guess gray ways that people try to get around it, and I mean, you just can't. So for example, if my local church calls me and says, hey Trey, can you help us with fixing our accounting books? And I go in and I do it, and I would have charged a normal business, say $500 for it, and I decide to do it, in this case, pro bono or for free, that is not something that I can deduct. That's just, again, in this case, $500 that I'm not going to collect. It's not something I can deduct. Even though, again, it was my time and my expertise that I donated. Now, what if, say, you worked for a soup kitchen for 10 hours last year? You can't just arbitrarily say that, okay, I generally would get paid $20 an hour at my normal job. I worked there for 10 hours, so that's $200 I get to deduct. No. You also can't say, people who usually work in kitchen areas in this town get about $15 an hour. Again, I did 10 hours in the soup kitchen, so that's $150 I get to deduct. No. So again, time and your expertise that you donate to, again, to a nonprofit is not deductible. So right off the bat, if you're thinking that you're going to be able to deduct some of that, you can't. So now that we're moving from intangible, the category, let's go to the cash one, because that's probably the most concentrated of donations that usually happen. Now, for cash donations, it doesn't have to be physical greenbacks. It could be charges to your debit or credit card. It could be Venmo, all of that. So any times that you've actually paid, dollars to, again, a qualified nonprofit, then that would be considered a cash donation. Now, it has to be actually made, the donation actually has to be made in that tax year. So a pledge that you did on, let's say, December 31st for $1,000, I'm just gonna make something up, but you don't pay it until January the next year, that pledge does not actually qualify you to take the deduction that year. It has to be in the year that you actually made the payment. So pledges really don't play a role when it comes to your tax deductions. It only comes into play, again, when an actual payment is made. And again, when I say payment, it can also be a credit card charge. So again, if I decide to go ahead and put some money for the Salvation Army on my credit card, and I don't pay the credit card off until, say, next summer, even though I'm not paying it until, again, next year, but the charge happened this year, I get to take the deduction this year because the credit card is seen as a cash equivalent in this case. Jumping back to the time, I actually did forget something here. Again, when it comes to the value of your time, that's something that you generally cannot deduct, but there is one thing that kind of sneaks into that category, and that's your commute or your driving time. Now, if you have to drive specifically for a nonprofit or that charity event you're doing, then you can very well potentially take a mileage deduction as, again, a charitable deduction. So in this case, at the time of this video, I believe the mileage rate is 14 cents a mile. It's not very much, but again, it's something that could add up depending on what you do. So for example, if you use your personal car for Meals on Wheels or something of that sort, that could very well add up. But keep in mind that the driving has to be specifically linked to that charity event. So let's say you have to go pick up some tools from the local tool store, and then you're driving to a job site to do manual labor for, let's say, Habitat for Humanity. The driving distance between the going to the store to pick something up and to the job site, that would begin to add up. But let's just say like you just give money to the church on a weekly basis, either for your tithes or your offerings, you can't deduct just your commute time because that's not really specifically linked to a specific cause. So again, the driving that you do, which again technically is an intangible time being donated, is not really deductible unless the driving has specifically linked to that charity event. And again, usually commute times really don't count. And again, that's when you kind of have to take it on a case-by-case basis to see, does the mileage that I'm incurring actually fit that charity event. Now, another thing to keep in mind is that you can also do what is known as the actual vehicle expense method. I think that's kind of what it's called. So instead of taking just 14 cents a mile, if you are able to determine the allocation between your oil changes and the gas you use and parking and toll that is used for the charity event, well, if you can take and substantiate and have documentation to back that up, and it's over what you would have calculated if it was 14 cents a mile, then you can go with that actual method. But I'm going to be completely honest, I have yet to meet someone who can actually determine that, after a $70 oil change, they were able to determine that 4% of that cost was going to be allocated to a nonprofit use. It adds up, and it's quite a bit of work. And again, when you're talking 14 cents a mile, it really, I don't know, it gets kind of tricky. So something that I personally don't see a lot, but I mean, if you are able to substantiate that, hey, I spent exactly $103.47 this year on my car that was allocated to nonprofit use, then hooray on you. Then yeah, you can substantiate it, and then yeah, don't take the mileage, take the actual if it's higher than that. Okay, so now that we talked about cash donations, let's talk about non-cash tangible property. This is things like your clothes, old toys, home appliances, furniture, things like that. Now this is where it can get a little tricky and a little bit more cumbersome because it's not as simple as cash, but for the most part, it's actually kind of simple if you just keep it kind of, low key. A lot of people that I deal with usually just donate old clothes and toys and stuff like that to a nonprofit. In this case, say let's say Goodwill. Now, when you do that, you can potentially take a tax write-off because generally when you donate something, whoever is the recipient of it, in this case, someone who is working for, let's say Goodwill, when you give them a bag of clothes, they'll ask if you want a receipt. Now, generally, they're supposed to fill it out, but around here, they don't. And this is where you can kind of get a little into the fraud category if you want to say that, you donated a whole bunch of Chanel and Gucci stuff, which, again, don't because that's fraud. But, again, you have to have something that you can substantiate that says, okay, I donated something of value that was non-cash. Now, in order to do this, the value of what you donate is actually the fair market value of the property that you're giving up, not your basis of the property and not your original purchase price of the property, nor is it the original purchase price of the property plus inflation. So there are some people that I talk with that try to get pretty creative with these values, and you really can't. It's pretty laid out that you have to use what's known as the fair market value for any non-cash tangible property. So, for example, let's say I go to Goodwill with a trash bag of 20 t-shirts that I'm trying to get rid of. Now, a t-shirt, let's say you can usually buy them, let's say I bought them all for $10 when they were brand new. Now, that doesn't mean that I get to take, I think I said 20 t-shirts. That doesn't mean I get to take 20 t-shirts times 10 and get a $200 deduction, because no, at the time that I donate the shirts, they are no longer worth $10. They've probably got sweat stains and maybe they got a little bit of a tear somewhere. They're no longer worth $10. Now, in order to find the fair market value of something, especially clothes, a lot of people just take what's known as the value of what it would have sold for in that thrift store. So in this case, if a t-shirt sells for $2 at a Goodwill and you're giving 20 t-shirts, then 2 times 20 is 40. And that's usually the kind of the way that you can kind of get a basis of what the actual value of that property is. Same thing with a furniture or home appliance or whatever. If you're given an old blender to the local church that expressed needs for one, that blender is no longer worth much to you, even though you may have paid, say, $600 for it, a few years ago. Used at a thrift store, that same blender goes for, let's say, $25. That means you only donated $25 to that local church or whatever situation it was. So again, it's the present fair market value of a non-cash item that you can actually get to deduct. I'm going to go off on a tangent here and tell you a little bit of a story just to kind of really highlight the importance of this, because people can get choked up and do something that is very harmful to their finances and their everyday lives. So this happened about 9 years ago when I was first doing taxes, and actually this is one of the very first tax returns I've ever worked on. I was working for it was an IRS Vita program, which is a free program that can help people who are have a lower incomes, just to help them with their taxes. And again, it's usually reserved for people who have very simple taxes and have a very low income. But I remember I was working with a lady. I remember she was single. I can't remember if she had a kid, so she could have been a single mother. But she came in and said that she donated her car. And this car, which obviously is a non-cash tangible property, said that she thought that she was going to get the same amount that she originally paid for the car as a refund. So right off the bat, there are two main issues here. Deductions, or when it comes to charitable contributions, those are deductions. Deductions are not a dollar for dollar benefit when it comes to your tax return. So, for example, this lady, she donated her car. I can't remember what kind of car it was, but at the end of the day, the detail that she had, the car had like a Kelley Blue Book of, let's say, $1,000. But she bought it originally when it, brand new or whatever, but it originally had a value of, like, let's say $20,000. This lady thought that she could give her car that currently only had a value of $1,000, again, Kelley Blue Book, that's a good basis for a fair market value evaluation. She gave this $1,000 car away to a qualified nonprofit and thought that she was going to get a $20,000 refund on her taxes, which there are two whammies here. Again, the value of what you can deduct is only going to be measured by the fair market value, not the original purchase price, not the original value, even if you weren't the original owner of the property. It's not your original basis. So all these other numbers that you can play with don't come into play. It's only the current fair market value. So I pretty much, as a new tax preparer, had to tell this lady, you gave up your car for nothing. You're not getting a refund from this specific event. And from what you gathered probably from earlier in this video, charitable contributions are only good in this case if you itemize. So this lady didn't even have enough to itemize, so she just took the standard deduction. So at the end of the day, she essentially gave up her car for nothing. And again, I knew this lady was single. I can't remember if she was, again, a single mother or not, but she took some bad tax advice from someone who said, hey, go give up your car because you're going to get the original purchase price of the car back as a refund, which is completely false because, one, you're not getting the value of the original purchase price as a benefit. It's only fair market value. And again, this was like a clunker, $1,000 value car. And two, the value of what you're donating doesn't automatically get added as a refund. It's a deduction, not a credit. So let's just say that she was not happy at all. So when it comes to donating non-cash, again, tangible property, there are some other rules you have to take into place. Now, if you are just giving up, say, just random items around the house to your local thrift store, that generally could add up to a couple $100 or whatnot, again, depending on what it is. But once you start getting into higher levels of donations, then some other rules are going to start to apply. If you're going to, say, donate somewhere in about the $500 range and up, you are going to have some sort of documentation saying that you are giving something up. Now, in this case, $500, again, for fair market value, that could be, some old furniture, lots of clothes or whatever. But if you are going to donate that much and hit this $500 threshold, you are going to have something that can substantiate that you gave X amount of items worth X amount of dollars on such and such a date to such and such charity, because that is going to have to be something that you have to be able to show in the event of an audit, or people are questioning why you're taking certain deductions. Now, if you are going to go even higher, around like the $5,000 range and up, like donating art or property, a house, things like that, then you have to have an appraiser's letter. So not only do you need to have a receipt that shows that you as the donor gave this property valued at, again, $5,000 or more, you're going to have an appraiser's letter to be able to determine that this was correct. So for people in my age, let's say that I gave Pokemon cards to my local, Make-A-Wish Foundation. So if I do that, and the value, again, I've got some pretty, when they first came out, I might have something in there. Hopefully, we'll see. But if at the value of all those cards that I've given up to, again, a qualified nonprofit exceeds $5,000, I have to have an appraiser who is an expert in Pokemon card valuation write me a letter that says, hey, Trey Tarmant is donating this list of Pokemon cards. Here are the value of each card. Here are the dates on which the transfer is being made. And that's something that I'm going to have to hold as a donor, again, just in case I ever get audited. So again, if you're just going to donate just a bag of clothes to your local nonprofit, and again, the total may come up to only like $30, $50 or whatever, you really don't need a receipt. I personally always like to see receipts because you can easily just say, oh, I donated X amount of dollars to, the local thrift store, but I don't have a receipt. Well, I kind of almost have to take your word for it, but it's really good to have a receipt for those kind of things. And again, if you get into like the $500 range and up, you are going to have a physical receipt that can prove that. And again, anything over $5,000, you're going to have to get an appraiser involved to actually start, substantiating all of that. Another thing to keep in mind to kind of wrap this up is that when you donate, you are actually expecting nothing in return, which I think is something that we covered at the very beginning of this video, and it kind of makes sense, right? If you're giving money to something and you're getting something in return, then it's not really a donation. But what if it was a qualified nonprofit and it was like a charity event, but you got something in return? So now we have to start asking more questions. So let's say hypothetically a local charity nonprofit in your neighbor or in your community is hosting a golf scramble, and tickets are $100. So you give $100 to this nonprofit, and then in return you get, say, an 18-hole round of golf, a couple drink tickets, and then a lunch at the bar after everything is done. So even though you gave $100, you did get something in return. So did you truly donate $100? No, because you got something in return. So in this case, you have to take the value of what you received away from what you gave. So let's say hypothetically, the value of the 18 holes is $40. The drink tickets are another $10, and the meal was $30. So I actually didn't even keep track of the numbers I used. Let's say the value of everything that was given back to you was $70. So you paid $100 to go to this event, and in exchange, you got $70 worth of benefits. So at the end of the day, you only donated $30. Now, you might be saying, Trey, what if I gave $100, but I did not go to the event? Or something that I have seen quite a bit is people will pay, they'll pay money to a charity. In exchange, they'll go to some sort of event, whether it's a golf scramble or a gala or a ball or some sort of event where they'll be fed and food and all that. But they didn't stay the whole time. They left before the main course, or they only played 9 holes of golf rather than 12 or 18. Excuse me. So what happens if you only take a portion of what they gave you? Well, if that's the case, it doesn't help you, because in reality, if you did have to leave early or whatever, or you didn't even go, the fact that you gave money up to, again, a charity, but in return you did not take their stuff, doesn't matter, because you were offered it and you just didn't take it, or you didn't take the full value of what you were given. If that's the case, then you can't just say, oh, well, I didn't take the meal and that meal was $20, so I'm going to add $20 to my donation. It doesn't work that way. So again, even if you did not utilize the event fully, that does not add to your donation. So again, if the value of what you had given up was $100, you got $70 worth of goodies in return, regardless if you win or not, for the full 100% of the time, or 50% of the time, or 0% of the time if you didn't even go. Your donation is only $30. Now, actually, who gets to take the deduction for donations? Well, prior to last year, it was for anyone that was able to itemize. Now, when it comes to itemizing, keep in mind that you have the choice of itemizing your tax, or your itemizing your deductions, or taking a standard deduction. Now, generally, you will want to choose which one is more advantageous and greater, because the higher the number, the lower your taxable income is. Now, donations were usually something that was in the itemized deduction pool. So the more donations you had, the higher your itemized deductions. If your itemized deductions surpassed your standard, then you would go with that route. Whereas if your standard deduction was higher, but you kept donating, but your standard deduction was still higher, then your donations never showed up on your tax return. Now, thanks to some recent tax law changes signed by former President Trump, there was some changes that were going into effect for last tax season that should be rolling forward. And that is, regardless if you take the standard deduction or not, you can deduct up to $600 if you're married, filing jointly, or $300 if you're single, of cash donations. Now, this is what is known as an above-a-line deduction, because it is something to arrive at what's known as your adjusted gross income. So regardless if you take a standard deduction or itemize, if you're single, you can get to take up to $300 of cash donations. And if you're married, filing jointly, that gets doubled up to $600. Now, again, I do stress that it has to be cash. So if you gave nothing this past year in terms of cash, If you've given nothing in terms of cash this prior year, but you just happen to donate, say, $300 worth of clothes to your local nonprofit, don't think that you'll be able to get the $300 deduction, even if you're taking the standard deduction, because again, that $300 or $600 limit is only for cash. Now, a question I do get quite often is, what about GoFundMes? Because that's a very popular website, and as dystopian as it sounds, it's mostly used for things like medical expenses and funeral costs and things to help people get out of a hard time. So how does that play into your taxes? Well, again, we just learned at the very beginning of this video that the difference between a donation and a gift is all dependent on who the recipient is. So GoFundMe's kind of act as a middleman, and it kind of gets a little cloudy. So here's a way to kind of think of it. If the money is going towards, say, someone in the community who has lost everything, regardless of the reason, that is a gift. So if the money is then winding up to, again, someone to help with funeral expenses, raise money for bail, things like that, then that's a gift. And again, gifts will be on a whole another topic, whole another video, because it's a completely separate topic. Now, I personally haven't seen it because I don't use GoFundMe a whole lot, so I'm not 100% guru in it. But apparently, GoFundMes do offer what is known as like GoFundMe charities. Now, if you do donate monies to that, then that is considered a donation, and that is a cash donation, excuse me, and that is again to a qualified nonprofit, and then that can add up into your your itemized deductions and the totals that you actually donate. So again, if it's going to a GoFundMe charity, then it's a donation. If the money is going towards, again, a local community person, family member, someone that you've maybe never met, and if it's going to like an individual person, chances are it's just a gift, and again, it's a completely separate topic. All right, well, I hope that makes some sense when it comes to donations and charitable contributions, because it gets pretty cloudy. And as you know, even though this video was pretty long, I probably just scratched the surface. So again, one of the things you really have to make sure on is the event or whatever the organization that you're giving to, are they a qualified nonprofit? And again, it's almost a case-by-case basis. But at the end of the day, one of the things that, again, to generally know is that if it's going towards, again, a school or religious institution or a charity, generally that means it's going to be a donation, and that's going to be completely treated different than if it went to someone who was like a friend or someone in the community, and that would be more of a gift. And again, that's going to be another video because it's a completely separate topic. So again, hope that helps. Again, happy tax season, and we'll catch you next time.